All right, all right. Welcome to Degrees of Freedom, where I go over 5 slides in 15 minutes about the note industry so we can discuss and learn more about our own degrees of freedom. Hello again, my name is Dr. Engerman, and I will be your faithful guide through this episode 5 of Degrees of Freedom. Today we got a hot one for you. It is landlording versus note investing. I think this is long awaited and people really want to understand the difference between the two. Is one better than the other? Well, we're going to find out. Listen, today we're going to go over rental math, rental responsibilities, note math, note responsibilities, and finally we'll wrap this thing up with landlording versus note investing. Listen, I don't want any further ado. Let's get right to it. All right, guys, landlording versus note investing. The very first thing I always say is that am not a CPA. I'm not an investment advisor. I am not a financial strategist, a lawyer, or any of those things. If you need that type of assistance, please go seek so elsewhere. Anyone states not liable for any losses resulting from any actions taken by a viewer based on the information presented or shared on this channel. Anyone states cannot promise earnings or returns based on historical reports or achieved by any party or affiliate in connection with the information presented. Listen, I'm really fired up about this one. I keep clicking the wrong page here, so that's why I keep flipping back and forth. Apologize. Listen, let's get right into it with the rental math, okay? And let me tell you how I did this. I went to about 5 different sites, from Smart Loans to the Loan Calculator, calculator.net, calculator.com, and some other sources to come up with these numbers. And basically what I'm going to do is a really straightforward comparison between a purchase property from day one, when we purchase that property as a landlord or an investor, right, a rental investor, and me acquiring a property that is a performing property from the note side of the house. That's the only way to make it fair, to do a fair comparison. Obviously, there's lots of differences and nuances between the two, but this is kind of the fairest way that I saw to compare the two ideas. So here's the basic idea here. We have a $100,000 loan, basic, at a 5% interest. We're basically going to have $1,100 in rent. That is approximately the value that I get from all the sites and resources that I have gathered. Your mortgage and interest payment will be about $429. Your taxes and fees will be approximately $140. Your insurance will be about approximately $104. We have to have a project manager. That's generally how these things work. If you want to go to scale, and I'm talking scale, right? So we're doing 8 to 10%. What did I do? A basic 99%. Rather 9%. We've got maintenance from 5 to 7% on a monthly basis. That's the general average, $66. Your monthly income will turn out to be somewhere in the $262 range. Okay, if you're purchasing a loan and it's higher than that, maybe you get a bit higher in-pocket amount. But basically what happens is you're getting about $3,144 approximately income. That is revenue minus expenses, y'all. And if you ain't speaking that language, you ain't the real deal. So this is what you get to keep in pocket. I say all in cash at $27,000. Here's why. We usually put a 20% down, and you have closing costs. All right, that brings you at a cash on cash evaluation of approximately 12%. Basic average numbers. This is pretty standard across the board. I would say, again, flat. There are nuances. Understand that when you do earn rentals, because you can use OPM possibly, but you come out of pocket $0, of course. And I understand loan rates can be much lower, but here's something basic and simple that I thought we could just run through, okay, to get some basic numbers. Now, on the left side, we've got a 30-year loan that is a performing rental. That's if everything goes well, right? Well, what happens if it's non-performing? What happens when your tenant decides not to pay? Well, we look at this side. We still got a $100,000 loan, still at 5%. We're not getting any monthly rents. Guess what you're responsible for? You're still responsible for that mortgage and interest. You're still responsible for the taxes and fees. You're still responsible for that insurance. And you probably don't want to pay a project manager if there's nobody paying you rent, right? Yeah. Okay, your maintenance is still intact. Your monthly income is a problem, right? This is when we talk about our vacancy rates, right? They kind of negate the earnings and gains. And then our yearly income becomes a problem. Our all-in cash is still the same, and we're at negative 33% cash on cash return. Again, a simple, basic breakdown of a scenario that is very likely and plausible. Let me talk about landlord responsibilities, okay? You as the landlord or the owner are responsible for the taxes, the fees, and insurance. Point blank, plain and simple. You are also responsible for the mortgage and the interest. Point blank, plain and simple. All home maintenance, that's up to you, and it is about the 5 T's. What are the 5 T's? You're responsible for, I said it already, one of them, the taxes, the tenants, the toilets, the trash, and the termites. That's the 5 T's, y'all. You're responsible for that as a homeowner. Point blank, plain and simple, period. You are also responsible for nuisance liens. What are nuisance liens? Well, just in case you haven't cut the grass, right? Or you have noise violations, things of that nature. That's a problem, okay? So you're responsible for those nuisance liens. Code violations, again, possibly cutting grass, might be some issues with that, or there could be some issues with some other codes that you're violating with what's on your lawn, possibly, okay? So you could have code violations if you don't fix a roof properly, or if you don't fix the paneling properly. Those are code violations, okay? They become your problem. Utilities are still in your problem, but you may pass that to your tenant. So you may be responsible for the utilities, you may not, depending on the municipality that you're in. I think that's fair to talk about. You're also responsible for the management and the collection. So meaning that you have a project manager, or rather, a property manager, and that property manager then has to be responsible for collecting those tenants and those rents, right? So these are all the things that you're responsible for as a landlord. Let's move forward. Look, this is the situation. For those of you that understand notes and note investing, this is a basic situation where you have purchased the note from a bank or from an institution. Okay, so it doesn't start off with the 30-year. That's origination. If we start with origination, that's a whole nother conversation for another day. All right, not for the beginners. And basically, you fabricate money, you generate what's called credit. All right, but that's not the situation. I'm trying to keep it fair. So we have an $80,000 unpaid principal balance because guess what happened? Most likely they paid 20% or some fraction of that. And so the numbers kind of just shift slightly a little bit. Your P&I still the same. Your servicer, you have servicing fees. It could be anywhere from 20 to $75. I just picked the number in the middle. You have your monthly income then, and then your yearly income. That's pretty much it there. If we want to start talking about other expenses, I've already calculated that into the all-in price. Okay, for my note investors out there. So what you're spending is about $64,000 on this performing note. Understand it's a performing note. And if you want to understand this math even further, you've got to see episode 1 where I break down what is a note. And we look at an amortization chart. Because if you have looked at that, you understand that that unpaid principal balance of $80,000 is not really $80,000, especially on a 25-year loan. You have to calculate in the interest, and you have to calculate some other pieces there, and you'll realize that that $80,000 unpaid principal balance is much, much higher. So when you're looking at a $64,000 investment, it's actually turning out to be a much higher return or asset. The cash on cash there is 7%, and you're probably looking back and saying, hold up, I saw 12% before, that's much higher. Yeah, sure, if everything goes well. That's much higher. But pay close attention. Non-performing side of the house, still an $80,000 balance, still 5% interest. Your monthly P&A, it's not coming in. You still have servicing fees, but your monthly income is minus 40. Your yearly income is minus 480. And guess what you get as a note investor? You get this really sweet thing called arrears because you have a contract. And that contract says that this individual still owes. And so on a monthly level, you still owed $441 and change. Now you'll notice that that's higher than the $429 because you have fees included in that bad boy. So actually yearly owed is a bit higher than that $4,668, and you actually turn out on top in this game because your cash on cash return is stable. It's a little bit higher, but it's stable. Guess why? It may take you a little bit longer to collect, but the fun thing about the note investing, it's still owed to you. Hey now. Hey now, what you say now? All right, so let me talk about this a little bit in more depth. A note owner has responsibilities. There are a couple more than these, but they are pretty negligible because we're talking about the finance, right? We're talking about the money, the numbers. Look, you are responsible for loan insurance. You have to have creditors insurance to hold down, secure your asset, okay, in case it burns down or something of that nature. So yeah, you're responsible for some loan insurance. There are servicing fees. We already went over those. That is a monthly fee to ensure A, that you're getting paid on time, B, that you're keeping up with your taxes, and C, if you need any legal support or legal help that can help not cover those costs, because that's another thing, that's for another day, but at least it can help you find those resources, and they work closely with that servicer in that jurisdiction. What's really cool about servicing as a note investor or for note investors is that you should be licensed in all states. Right? So you're going to find a servicer that should be licensed in all states, and they understand the rules and regulations in those independent municipalities. Okay, so they're specialized. There's a specialized service and a specialized system for you. So with the note owner, the reality of the matter is that you're not responsible for those 5 T's. What were the 5 T's? I'll remind you. The tenants, the taxes, the toilets, the trash, and the termites. That is not your responsibility. The real trick is this, and this is why this is a golden nugget. You ready? We pass that on to the owners. You see that? You see what happened there? You saw what I did there? If I were to go back, I'd show you that very clearly in the previous slides. There was taxes, there was insurance, okay? And there's all these other bits and pieces that the note owner is not responsible for. It allows them to free up their time and actually do the administrative work that they have to do, which is paper. It's a paper game, y'all. It's a paper game. That is the golden nugget. Okay, here we go. I'm going to move on. Listen, landlording versus note investing head to head. What are we looking at here? I broke this down based on responsibilities and based on, what the essence of the investment strategy is like. Okay, so on the left side we've got landlording. You've got high cash on cash return. That's why it's so attractive, and there's no doubt about that. In terms of a head-to-head cash on cash return, if things are going really, really well, your landlording could be incredibly profitable. Let me be very clear. It could be incredibly profitable. I haven't showed you the other styles and strategies and types of paper on the note investment side, which could be even more profitable. Okay, that's a conversation again for another day. But check it out with the landlord. High cash on cash return. The other thing is tenant dependent. So you are really dependent on the fact that you've got tenants in the property, period. Or else you get vacancy rates. And that ain't good. We know that's not good. We found that out with COVID, right? A lot of mom and pop shops and smaller landlords, they got washed out. And who they get washed out by? Well, again, if you looked at episode 4, you'd see who they got washed out by. A lot of the big hedge funds. Market dependent. It really is market dependent. So depending on where you are, if you're in New York or New Jersey or California, you've got really unique markets there where they may have high rents, but then you've also got high costs. So you've got problems there. In certain nuggets in areas, they have high rates of living, and maybe the properties have lesser values, and these may be in certain pockets of Pennsylvania, for example, that I know, in other areas of possibly Texas and other states. Hyper localized though. So you really got to lock in on your state and your municipality, right? You've got to get those on the ground relationships. And yeah, it's hard for you to have property in different states as a landlord. It's really difficult to do so. Not that you can't, but it's definitely difficult to do so. Maintenance is key. We already talked about that because you're responsible for the maintenance of the property. No question about that. And then you got project management. If you want to go to scale, you've got to have a project manager. Otherwise, you're burning time all day long. Look on the right side, though. We get to choose what the cash on cash will actually be because we have more of the say-so and the power, especially if you've got a lease option. You can actually get to determine what type of paper you write up and how you write it up and the length of the contract. Contract dependent. You got to get really wise with that, so you got to lawyer up. Vendor dependent. You have to understand that not all lawyers are equal, and servicers are not all equal. And then you have to think about contracting if you would like to. Contracting meaning subcontractors and things of that nature. If you want to build, you can possibly build, or you can just pass that on to a landlord. It's nationwide, so you can actually invest in all different states and with minimal amount of work in comparison to the landlording experience. And servicers and lawyers are your daily bread, I would say, but they are your vendors that you really have to have really tight relationships with. And then you need administrative management. So it's a little bit different than the project management, which is very broad, very large, and very intricate. Here's the deal, though. At the end of the day, you get to decide how you want to make money. And I'm not saying one is better than the other. That's kind of the trick at the end. It's not that one is better than the other. There is a preference. Some people have really strong management skills and they really like working on houses and they like to spend the time doing so and meeting people on the ground. That's fantastic. But I got to tell you, note investing, it takes a lot less energy, a lot less stress. It's more paperwork, it's less time, and it's actually more control. So when you talk about your degrees of freedom, you got to understand what's your preference. And not that one is better than the other, but they have different pros and cons that you need to understand and improve upon. So that's all I've got for today. In 15 minutes, that's really all I can do. If you'd like to know more, please come and see me. Whoop, let's go there. I know I'm bouncing around. Come and see me here at my email. Check out our page and like, subscribe, and hit that notification bell. Take it easy, y'all.